Opinions expressed herein are subject to change and not necessarily the opinion of the firm. Past performance is no guarantee of future results. The information presented herein is for informational purposes only and is not intended to provide personal investment advice. It is important that you consider your tolerance for risk and investment goals when making investment decisions. Investing in securities does involve risk and the potential of losing money. The material does not constitute research, investment advice, or trade recommendations.
And now introducing Mr. Keith Lanton.
Good morning, everyone. Happy New Year to all those celebrating the Jewish New Year. So we're going to get started this morning. We're going to talk about financial markets. Lots going on with what's taken place. Obviously, a volatile week last week. We saw markets, equity markets, gyrating with in particular with the PMI that came out last week, showing that the manufacturing economy was weaker than expected. Then we got the services index, which also came in weaker, although still above 50, indicating that services are still growing, but growing at a slower rate than was anticipated. And the concern is that the effects of the tariffs are starting to work their way deeper into the economy and perhaps undermining spending, consumer confidence, and overall economic activity. We'll see if this is something that's short-term or more long-term in nature, or if possibly the effects of this trade war will lead to some possibility of further discussions and possibly a deal between the U.S. and China. Also, last week, some of the information regarding the whistleblower and the allegations made against President Trump and some of the members of his administration. Perhaps that had an impact on the financial markets and the psyche of the financial markets. Also, it's possible that the rise of Elizabeth Warren in the polling numbers is something that is starting to concern financial markets. Elizabeth Warren historically has taken positions that the financial markets have viewed as unfriendly towards more capitalistic, more risk-taking oriented businesses. And with her rise in the polls and possibly becoming a viable Democratic candidate, combined with the events of last week, which may make some of President Trump and his ability to get reelected become more challenging. Markets starting to, at the very least, weigh those possibilities, and perhaps her candidacy starting to affect, and her possibility of, or potential or probability of getting elected starting to affect financial markets. So events that certainly need to be thought of, and perhaps position portfolios. Perhaps you have to start thinking about what some of the candidates are thinking. Obviously, what President Trump's views are, and the probability that he gets reelected versus Joe Biden or Elizabeth Warren or any other candidate that emerges as we approach election season. And this election season looks to be more dramatic in terms of the effect it may have on financial markets, because we have candidates even within the Democratic Party, but certainly across party lines between Democrats and Republicans, whose platforms look so starkly different and have such different views in terms of policies that would affect markets, affect policies throughout the country, whether it's healthcare or social issues, and the implications of those differences perhaps greater than we've seen in previous elections, and the outcome of the election perhaps could trigger different winners and losers to a greater extent than we've typically seen. So we'll get started talking about the financial markets this morning. We are seeing S&P futures trade about 8 points or 0.3% below fair value. Futures have wavered in negative territory pretty much all evening, as investors are contemplating whether or not markets, which are still relatively close to highs, deserve to be at the levels that they're currently at. Perhaps the biggest guiding news this morning is on the trade front. Bloomberg is reporting that China is more reluctant to agree to a broad trade deal and is not committed on reforming Chinese industrial policy or government subsidies. President Trump's calls for China to investigate candidate Joe Biden could also complicate talks, according to the New York Times. High-level talks will resume in Washington on Thursday and Friday. Separately, labor talks between the UAW and General Motors have taken a, quote, turn for the worse, unquote. Also, over the weekend, a second whistleblower has come forth against President Trump. Although that's not market-moving, the negative-sounding news may be contributing to the general sense of uncertainty in the market. U.S. Treasuries have edged lower, pushing yields slightly higher across the curve. 2-year is up 2 basis points. We're still looking at a very low yield of 1.41, and that's even low compared to where we were a week ago. 10-year yield up 2 basis points to 154. Dollar remains strong, is up actually slightly this morning. And crude up this morning about 1.3%, 66 cents to $53.47 a barrel. Today's economic data limited to consumer credit for August. That's coming out at 3 o'clock Eastern Time. Taking a look at overseas markets, equity indices in the Asia-Pacific region began on a mixed note with markets in China and Hong Kong closed for the holidays. Japan's Nikkei was down 0.2%. India down 0.4%. Korea up 0.1%. Australia was up 0.8%. Europe up pretty much across the board, anywhere between 0.4 and 0.5%. Silver and gold relatively unchanged. Gold is down about $8 an ounce to $15.04 an ounce for gold. Also reports this morning that President Trump is aiming to support Turkish military operations that would move away Kurdish forces that are near the Syrian border. That is something that is a change potentially in U.S. policy with respect to the Kurds who we've typically allied ourselves with and the U.S. has sought to protect. We'll see what the implications are of that policy change decision. Trump administration removing tariff exemptions on some solar panels. These products are now going to be subject to 25% tariffs beginning on October 28th, pushing up stocks like First Solar, FSLR, which makes solar products here in the U.S., so they gain an edge against foreign competitors. General Electric announcing it's going to freeze pension plans for about 20,000 employees as part of a broader effort to reduce the pension deficit by about $5 to $8 billion. They're also seeking to reduce net debt by $4 to $6 billion. The stock up a few cents this morning. It's possible this move could have a broader impact on the bond market as they seek to reduce debt and possibly strengthen their balance sheet. So we'll see if that translates into strength in the corporate bond market for General Electric. General Motors down slightly this morning. I mentioned that talks between the UAW and the company have hit an impasse this weekend. That was after some optimistic comments from the union just over the weekend prior to that commentary that they've hit an impasse. This morning, a couple of the discount brokers were upgraded. E-Trade upgraded at UBS to buy from neutral, although they did lower their target to $41 there. UBS did lower Ameritrade to neutral from buy and lower their target to 33. Going to talk a lot about the impact of the lowering of commissions to zero at some of the discount brokers and some of the implications of that. So other things to focus on, to look forward to this week. On Tuesday, tomorrow, we have the Bureau of Labor Statistics releasing its Producer Price Index for September. We're looking for a 0.1% increase. Core is expected to increase to 0.2%. Obviously, these are important numbers as the Federal Reserve has to gauge whether or not they will be making any future changes to interest rates. Tuesday evening, also the beginning of the Day of Atonement, Yom Kippur, for those who observe the holiday. On Wednesday, we get the release of the Federal Open Market Committee minutes, and that is when minutes from the meeting where they cut the rate of the Fed funds rate by 0.25% to the 1.75% to 2% target. So markets will be looking for what the commentary around that decision looked like there. Thursday, we get some earnings from Delta Airlines, and I will talk a little bit further on that as well. So moving on to Barron's. Barron's headline story was market-moving event last week when Charles Schwab reduced their commissions on equities and options to zero. Those options going to zero did not include a contract charge of 65 cents. I will emphasize that the headline said that the commissions went to zero. Those are the commissions for online trading and mobile trading, not for the broker-assisted trading, which still remains a commission in effect and significantly higher than zero for those. The charge to do an option trade is zero on the commission and 65 cents a contract. And again, that is not the broker-assisted charge. That is the charge if you are speaking with a client. So Barron's headline story: Charles Schwab and the new broker wars. As the headlines were filled last week, Charles Schwab reduced those rates, and they were followed in suit by E-Trade, Interactive Brokers, and TD Ameritrade. Fidelity and Vanguard seem to be holding out for now. While customers may be delighted, analysts slashed their estimates and tried to figure out who the winners and the losers potentially would be going forward. Barron's, in their opinion, suggesting that if there is a winner, it's likely to be Schwab, though the company faces significant near-term challenges. They suggest that the move was made somewhat at the behest of trying to pinch startup trading apps like Robinhood, and they conclude that Schwab is likely to emerge stronger than rivals that don't have Schwab's diverse business lines to prop up revenue as commissions go away. Now, Keith Douglas gave me an article that was in the Journal this morning that talks about the same subject. Journal and Barron's are sister publications, both published by Dow Jones, and similar theme. In this article, freedom isn't free and free trades aren't either. And what this article goes on to explain is how Charles Schwab and others, but particularly Charles Schwab, is able to remain profitable and not charge for doing transactions that are done online or over a mobile app. And what the article explains, lots of individual investors may not be aware, is that Schwab and other brokerage firms are in the business of making money. They're not in the business of just doing free transactions. And the one way they do that, when you trade for free, you still pay, but you're paying at a different toll booth. In fact, the term brokerage is becoming a misnomer. As the Wall Street Journal stated, firms like Schwab are more like banks than brokers. In fact, Jamie Dimon, in a recent conference call when he was discussing his competitors, mentioned Charles Schwab 7 times, dramatically more than any other financial institutions. Commissions at Charles Schwab now amount to less than 7% of Schwab's total net revenues. They were 14% 5 years ago. What Charles Schwab has been quietly implementing is a policy of transitioning sweep accounts, brokerage sweep accounts, from what would be considered traditional money market accounts that pay somewhere in the neighborhood of 1.5% to 2%. And what they've been doing is they've been changing their sweep account option on their accounts to an FDIC-insured money market account. And as of June 30th of this year, the total assets in that money market account totaled $208 billion. And the clients that were invested in those money markets are earning anywhere between 12 and 55 basis points, as opposed to rates that would be significantly higher in traditional money markets. The article also points out that clients have the option of, instead of choosing a sweep money market, which automatically gets bought and sold as you do transactions, to move to a higher yielding money market that is not a sweep option. But lots of individuals in the public are not aware of that option, or alternatively, it is a laborious, time-consuming process and may not take the time and engage in the effort to capture those higher yields that are available in the traditional money markets that you have to buy and sell. Also, the article points out that Schwab recently launched its intelligent portfolios, been immensely successful. These are portfolios that are robo-portfolios that buy and sell ETFs on a automatic basis. And critiques that the journal article makes of these robo portfolios is they require investors to hold anywhere between 6 and 30% of the money that go into these robo platforms at Charles Schwab to remain in a cash option, and that cash option is in effect subsidizing the free trades and the software behind that robo platform. So we'll see how the implications of this change continue to affect the marketplace. Robinhood, which is perhaps one of the competitors that Charles Schwab has in their crosshairs, so to speak, has been gaining market share with commission-free trading, also with the ability to trade cryptocurrency. Robinhood has achieved 6 million accounts. Not clear how much that represents in assets. That has not been public, or at least I haven't found it. But Robinhood, in the latest round of valuation, had a market cap of $7.6 billion, and that's a valuation through private equity financing, hedge fund financing. And E-Trade's market cap is about $8.6 billion. So Schwab is certainly aware of who's in their rearview mirror, and trying to make sure that that person in the rearview mirror does not overtake them, as they overtook some of the previous giants in the financial services space. Just to put in perspective the size of the bank business at Charles Schwab, their bank business is now larger than Ally Bank, KeyCorp Bank, and Fifth Third Bank in terms of assets that they hold within their bank. And their net revenue from their bank was just under $6 billion, which is about 57% of their total revenue. So Schwab has become a very interest rate sensitive, bank-oriented firm as a result of the changes that they've made, and become a lot less of a traditional brokerage firm. Changing gears, talking about a couple of other stocks, and we'll talk about the general economy. Then we'll talk about bonds. A company that was mentioned positively in Barron's, this one in the technology space, and this stock, which is Taiwan Semiconductor. The symbol is Tango Sam Mary Charles. Taiwan Semiconductor Manufacturing. Actually, they've lost the C on the symbol, so just in case you're looking it up, it's Tango Sam Mary is the symbol. And Barron's writing a very positive article, and specifically addressing some of the advantages that Taiwan Semi has versus their competitors, and how Taiwan Semi may be the single best play on 5G. And Barron's is suggesting that TSM may be that company. Taiwan Semiconductor, what do? They manufacture chips for lots of companies that you think of that make chips. In fact, they don't necessarily make them, but Taiwan Semi does for them. Their clients include Apple, Qualcomm, Huawei, the Chinese company, NVIDIA, and Advanced Micro Devices. They all rely on Taiwan Semi to make the most demanding chips used in smartphones, servers, artificial intelligence, and networking devices. JP Morgan estimates that Taiwan Semi accounts for about 50% of the world's chip-making revenues and 80 to 90% of the profits that are derived from chip-making. Now, recently, Taiwan Semi became the first chip manufacturing company to offer 7-nanometer chip production at significant volume. These are smaller chips. They offer greater performance and improved power efficiency. The entire chip industry is trying to get to 7 nanometers in their manufacturing processes and make the transition there, and many are struggling to do so. In fact, Intel, which manufactures and fabricates its own chips, is unlikely to have 7-nanometer products before 2021. In fact, some of the weakness in Intel stock, some of the strength in AMD stock, is attributable to the fact that AMD is able to deliver on 7-nanometer, and Intel isn't, and that's because AMD is getting those chips from their relationship with Taiwan Semiconductor. Chip demand is continuing to grow despite the fact that there is a trade war going on out there. Taiwan Semi is not necessarily tied to any horse in the chip war race. In fact, when the U.S. banned U.S. companies from selling chips to Huawei due to national security concerns, Huawei only turned to Taiwan Semi to seek their assistance to a greater degree and to utilize their technology to a greater extent. So to some extent, the who wins and who loses is not as important to Taiwan Semi as long as the demand for those chips remains strong, as long as consumers continue to seek 5G, artificial intelligence, automated driving solutions. Taiwan Semi may be the company that continues to benefit from those trends. Going to change to a completely different industry, one that historically has not been one that most investors look at with a twinkle in their eye. But this is the airline business, and Barron's positive on Delta Airlines. Stock sold off 8% last week after they lowered third quarter earnings guidance, citing higher costs. Barron's saying even so, investors can expect to hear good news on Thursday when Delta releases their quarterly results. Barron's is expecting revenue to be up 5%, earnings soaring 26% to $2.27 a share. And they say that the disconnect between the recent price performance and the expected earnings could be a good time to buy Delta shares. At $53.70, the stock trades for just 7 times next year's earnings and yields nearly 3%. One additional benefit to the Delta story is that Delta does not fly any 737 MAX jets, so they have not been impacted by the problems with the Boeing planes, and are not as affected by the delay in getting those planes back into the air. It's been an opportunity for Delta to win business from some of their competition, and their job is to continue to try and keep those customers now that they've been able to take advantage of some of the disruption at some of their competitors. Moving on to the bond market, interest rates, which we saw drop significantly last week on expectations that the weakness in the economy would fuel further interest rate cuts. Perhaps some of the reason that we saw the rally in the market on Friday, the bad news becoming good news scenario, because the good news is the Federal Reserve may lower interest rates again. And Barron's suggesting that the Fed may in fact lower interest rates again, perhaps not as much as the market hopes, but their concern is that interest rates alone can't prevent a recession. What the thesis here is that monetary policy or lower interest rates is only one side of the stimulus equation. The other is fiscal policy, which is public spending, which is controlled by the federal government, and the Federal Reserve can't do it alone this time. So investors need to watch Washington as closely as they watch the central bank. What's taken place here is that we did get a significant fiscal policy bump when President Trump's signature accomplishment, his 2017 tax reform, went into effect, which certainly qualifies as fiscal stimulus. And by many measures, it worked. We saw a big rally in the equity market. We saw company earnings grow more than 20% in 2018, much faster than in recent history. But as we're all aware, what's taken place in the last 12 months is that we've had the U.S. and China engaging in a war of words, and those words have escalated to tariffs, and that has become a fiscal drag. Some economists suggesting that the drag now is almost reaching the point where the benefits of the tax cut are being offset by the negatives of the trade war. So the fiscal stimulus that we've seen has been negated. So what investors really need to keep keen attention to and an eye on is what takes place here between the U.S. and China. A real bonus that most aren't expecting, including the authors of this article, would be some sort of infrastructure spending to improve bridges and tunnels, but authors acknowledging that may be too much to ask for given the political climate in Washington, D.C., so perhaps the best we can hope for is some sort of abatement of the trade war. In the interim, it's possible we could see lower interest rates if there is not a somewhat of an easing or a resolution of the trade conflict. But the Fed may well be in sync with the authors of this article that cutting rates dramatically would not necessarily, in of itself, lift the economy out of recession, and possibly could even cause other unintended consequences. So perhaps the super deep rate cuts that the market is hoping for may not materialize. The best tonic or cure for this market may be an easing of the trade situation or some other fiscal stimulus coming out of Washington, D.C. Finally, I'll conclude with an article that was in Barron's that Keith Douglas also shared with me, and just interesting, perhaps a sign of the times when you start seeing articles like this, called 100-year muni bonds might just be the safest yield play. And that's a wow moment when you see a major publication talking about 100-year munis being a safe yield play. That is a complete revision of expectations going forward. If you were to read a major financial publication just 10 years ago, but certainly 20 years ago, I think that you'd see very few people speaking comfortably about investing in 100-year bonds and proposing the investment in 100-year bonds with the uncertainty of what interest rates may look like. But Barron's suggesting that 100-year bonds may just be a good risk-reward given how low interest rates are and given how strong some of the issuers are that are issuing 100-year bonds, because in order to get 100-year bonds sold, at least at this point, people really want to be confident that you're going to pay those bonds off. Now, Barron's talks about a lot of these municipal bonds that were issued as century or 100-year bonds, but I will emphasize that many, if not most of these bonds, are taxable bonds. They may not be subject to state or local taxes depending on where they are issued. But Barron's point is, even when compared to a taxable debt, and certainly if you take into effect if you can get some sort of state tax exemption, these bonds look attractive relative to what else is out there in the marketplace and what it's yielding. So they speak about Ohio University bonds that come due in 2114. Those have a yield of 4.12%. Recently, New Jersey and Rutgers University issued 100-year bonds, and those bonds are yielding about 3.9%. On the lower end, just to give you an idea of the marketplace, 100-year bonds that come due in 2119, recently issued by the University of Pennsylvania, yielding about 3.2%. Now, 3.2% for 100-year bonds, certainly to those of us who have been around a long time, sounds fairly or very low, but still represents over 100 basis points over what 30-year treasuries are paying. So perhaps you're getting compensated for some of that time premium here of tying your money up for 100 years. Now, the thesis of this article is don't take every penny you've got and go out and buy 100-year bonds. But if you think interest rates are going to continue to fall or may continue to fall, then locking in low rates in a non-callable bond that go out a long time may be a good way of making sure that you have the income you need in order to fund your retirement. And the thesis here is that regardless of what interest rates do, if these bonds were to provide you with the income you need and meet your needs, then even if interest rates were to go up and go up significantly, that it wouldn't matter so much to you because you're getting the income you need in order to enjoy the lifestyle that you are seeking to live. So that's everything I've got.
Thank you for listening to Mr. Keith Lanton. For more podcasts, please visit our website, www.lanternwa.com.